Hello Sector Watchers, welcome to the show. This is the 193rd episode of Sector Spotlight for Monday the 16th of October. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. And I have to apologize for 2 weeks of hiatus. I've been traveling to a conference in Jakarta, Indonesia. And I just got caught up with catching up stuff, etc., etc. Bad excuses, but here we are, 2 weeks later, episode 193. I should have done the monthly review, the monthly completed charts, but it's already halfway through the month of October, so probably not any added value in doing that again. So I'm gonna pass on that for this month, but we'll do it again at the first day of November that will be. Anyway, for today I want to take a very thorough look at rotations that are currently going on in asset classes and in sectors. Ladies and gentlemen, this is Sector Spotlight. Starting with the rotation of asset classes. On the left hand side we have the weekly rotations, on the right hand side we have the daily tails. And they are quite contradicting, I have to say. Not always, but it's hard to read, which means that it is a market that is trying to find a new direction or establish a direction. If we start with stocks and bonds, the highlight of this, the most important rotation there is, I think, then we see on the weekly that SPY is inside weakening, but moving towards lagging. It's at a negative heading. And we see that the opposite side, which is, if we focus on the fixed income stuff, Gov, corporate bonds and high yield, they are inside improving, or high yield already just inside leading and at a positive heading. The fact that SPY is still on the right hand side indicates that stocks are so far still the preferred asset class because they're on the right hand side of the fixed income tails. If we take that to the daily RRG, then you can see sort of an opposite rotation. You can see that SPY rotated through weakening and lagging, as you can see here, but very close to the benchmark, and now started to move back up. That weaker rotation on the daily is obviously caused by that weak rotation on the weekly, or vice versa. The weakening on the daily is causing that weekly tail to move into weakening. Nevertheless, SPY seems to be picking up again and heading towards the leading quadrant, which means that if that continues, then there is strength in stocks which could, pull that rotation, that weekly tail back up again before it hits the lagging quadrant. If we look at the opposite side where we have the fixed income tails, then we can see government bonds, high yield, and corporate bonds. So corporate bonds already inside lagging, government and high yield trailing, but they are all heading towards that lagging quadrant, or already in there, which kind of confirms, or this is very clearly a preference for stocks over bonds, at least on this, over the last 5 trading days, that rotation. And if we put that back on the weekly, then that sort of rotation can easily cause a rotation, definitely for Gov and corporate bonds, to rotate inside improving and move back down, bringing the comparison between stocks and bonds clearly back in favor of stocks. We'll have a few other charts in a minute to look at, but that is the sort of conflicting situation that we have in the near term and in the long term. And I think it's just a matter of having to wait and see how this plays out and try to stay on the bandwagon, because personally I'm still quite positive. I've got a positive bias in favor of stocks, but I'm ready to change that opinion when this rotation here on the weekly really continues and pushes SPY into the lagging quadrant, or close to the lagging quadrant. If I take a look at the other asset classes here, so that would be commodities, that's DJP and GSG. They're long-term, very bullish, very strong. We've seen those charts, and you can see that they are losing some relative momentum over the last few weeks, and that's clearly visible on the daily tails where you see DJP and GSG moving into the lagging quadrant. But with the strength of those weeklies, I am actually quite happy to stay on the scenario that commodities are in a long-term trend turnaround in favor of commodities. So they are getting better and getting stronger over time. If you take a look at the US dollar, that's an interesting move. You see here the dollar index powering off into the leading quadrant. So that suggests a strength for the US dollar. And I think that is the case across the board. So a bullish view for the US dollar going forward, with a little caveat. We also have the chart of the US dollar and euro dollar in a minute. We have a better look at that. And then we have Bitcoin. And you can see Bitcoin here inside the lagging quadrant, but now starting to move higher. And that is caused by that strength that you see on the daily, because here's the Bitcoin tail on the daily, and you see that it made a big move through leading. It's now losing some of its relative momentum, but it looks as if Bitcoin is trying to get back on track. The short term is definitely doing it, and we're trying to pull that weekly tail back up again. Let's take a look at some of these individual stocks. If we start with the US dollar index, then you can see how that downtrend that started and that basically got, you know, a new trigger here when it dropped below this important support level. That was in July, and then we hit looks like a minor support level. It's a high that was formed in March, and out of that low, all of a sudden you got this massive rally. And it's impressive, I gotta say. I mean, even that overhead resistance here around 105, 106 has now clearly been taken out. And you know, this is a strong chart. The only thing is, at some stage we will need some sort of a corrective move for this rally here. But we now have a few serious previous resistance levels that we can expect to act as support in case of such a decline, if it comes. And we don't know when it comes. Now let's take that to the euro dollar chart, and here is the weekly euro dollar, and you gotta keep in mind that this is the reverse of the dollar index, or kind of the reverse of the dollar index. So here we had that move higher, and that all of a sudden that decline coming out of that 112.80 peak. It's now resting, looks like temporarily, at support around 104, 105. Maybe if this, you know, this is a support line, old support is going to act as resistance. So you could see a rally towards, I don't know, 107, 108. And that would perfectly fit the picture of a first corrective move. But what we're really looking for is a break below this support area here, so 104, 105. If that gives way, we're wide open to move to new lows, or at least to test the one that it's like just below parity, 97, 98 area for euro dollar, which would be a pretty massive move, by the way. If we take that to the daily version of this chart, then you can see that better pronounced. So here is 104.80, 104.5 is an important support level right now. You can see how this trend channel has been developed, lower highs, lower lows, pretty regular basis. And this seems to be the first major or important resistance area around 106.40, 106.50, where we just bounced off and started to move lower. So again, I'm looking for euro dollar to actually go below 104.50 and continue its downtrend and continue to strengthen, so the dollar continue to strengthen actually. If we go to SPY, then that's obviously, there was a bit of a, I don't know how to say it, confusing period. I don't know. I mean, it looked as if everything was very good, and then we got this kind of lower highs, lower lows situation. Market is very well respecting its historical support and resistance levels. So here is 460 area, and now very recently we tested 420, which we didn't quite reach, but or 418, and then we dipped at 420. So we didn't quite reach that level here. But I think 418, 420 is close enough for me to say that that support area has worked. and we now jumped higher. So now the question is, how fast or when can we actually turn this around? Because we do need to turn this around now into a new move higher and preferably break 460. But if this continues, then we have to review the assessment that this is a new uptrend for SPY, and this is a temporary setback within that new uptrend. That's the, for me at least, the preferred scenario. So I'm actually looking for this dip, this little decline to end. The strong relative strength is helping with that scenario because we are still trading on a relative basis above our early 2022 highs, which is a positive thing. And you can see how the RRG line, the RS ratio, is still well above 100 because this move is still clearly higher, but it's losing strength because it didn't continue its rally after the break, and that's why the RS momentum line has now dipped below 100, so it's indicating a loss of relative momentum. I'd say that as long as relative strength for SPY versus VBINX remains above that breakout level, and hopefully we can take out the previous highs, then we will see the rotation of SPY on the RRG, so that's this tail here, actually curl back up and move back up to leading, and SPY firmly taking the lead again over fixed income. Right now, that's not the case. SPY is still leading, but not firmly, definitely not firmly. If we look at the price chart of SPY, we can see this in a little bit more detail. The low at 420, just above 418 highs. The only thing that we can sort of argue, and we'll see that in the next chart, is a potential head and shoulders pattern that was formed here. Let me go to that chart right away. Here you see that alleged head and shoulders pattern where we could see the first breakout, and then this would be a pullback. If that scenario plays out, so that would mean that we will not take out that 437 high that was set last week. That would mean that we're on track for a decline towards 405. As I said, I'm still biased to a more positive view. I think that that 420 area was an important support level, and that we can see the market pushing higher potentially this week already. If we take out 438, then I think that we're back on track for a test of the highs here around 460 in the S&P 500. If you look at the fixed income stuff, and that's really, it remains fixed income, interest rates remain the Achilles heel, remains the danger, remains the factor to keep an eye on, because GOVT has definitely broken that previous low, and so has IEF. So GOVT is the entire curve, IEF is the 7 to 10 year segment, and you can see how they are, you know, the RRG lines are going higher, but the relative strength, the raw relative strength, is still not in the best of shape. It's the reverse of SPY, essentially. So here, with this relative strength continuing lower, it is very well possible that we will see IEF and GOVT rotating down again inside the improving quadrant. So there's these two blue tails here, and starting to move lower again and move back to lagging. And then that will be a firm confirmation of a preference for stocks over bonds. Again, we're in a tricky situation right now because the break is very clear. That is not good. And the stock market has not taken out those accompanying highs in the stock market, I've got to say. So from a relative point of view, I'm still in the scenario preferring stocks over bonds. But it's going to get tricky, and we do need to see a renewed rally of the S&P 500, hopefully taking out the previous highs, because that will bring everything back on track. If we look at that in the ratio chart itself, so SPY IEF, then you can see that it is in a range here, and we do need to get out of that range. What is not good is that negative divergence that's building up. So if you monitor the SPY IEF ratio and you see it dropping below 460, 4.6, I think that'll be the trigger for bonds starting to outperform stocks. So the charts that you want to look at are the RRG with those tails, SPY, GOVT, maybe IEF, daily and weekly. Then you look at the ratio of SPY versus IEF. If that breaks below 4.6, it means that this negative divergence is going to materialize. That would be a signal to move out of stocks into bonds. If that does not happen, if we are staying in the situation as we are still preferring stocks over bonds because this is the long-term breakout and we will see a break to the upside. That's definitely a favor of stocks. That's the preferred scenario, and that would mean that you will see the tail of SPY curling back up and moving into the leading quadrant, and you will see GOVT and potentially also corporate bonds and high yield rolling over and starting to move in a negative direction. If you look at Bitcoin, longer term, I think I told you 2 weeks ago, 4 weeks ago again, we do need to see improvement in Bitcoin quite rapidly to not lose the strength that we had coming out of this bottom. It looks as if we are doing that right now, because especially when you look at the daily chart, so this is updated through right now, so on Monday, this is intraday, you see a big move here for Bitcoin jumping to 29K, and we're now back in an important range. We took out that, what was this, 27, 28 area, so we're taking that out all of a sudden, so there's a lot of buying activity going on. So there is now strength building up, and it looks as if this week is going to be a good week for Bitcoin, especially if we can continue this rally. And as I said, it's the overhead resistance area, and it's a wide area. It's pretty vague, but I would say between 30 and 32. So these highs are 31.5. If you look closely, you can find a few around 32. But if we can take those out, that would open up the way for much more upside potential in Bitcoin in the coming weeks. Let's move on and see what is currently happening in sector rotation. And I'm going to slice it in three, as you probably know, offensive, defensive, and sensitive, because I think it makes good sense and it separates the various areas of the market. If we start at the offensive sector, so that is financials, materials, discretionary, and real estate. And we've got the weekly RRG here on the left and the daily on the right. And especially the weekly is pretty clearly in a negative rotation. So we've got real estate already hitting lagging. We've got materials rolling over, inside improving. We've got financials, well, it's inside leading, but already heading lower. And we've got discretionary inside weakening and rapidly heading towards lagging. So that is I would say, a pretty negative rotation. If you look at the daily counterpart of those tails, then it's predominantly confirming what's going on. The only one that's really different is real estate, but it is, if you look at the reading on the RS ratio scale, it's clearly the lowest. And with this type of rotation on the weekly, I wouldn't be surprised if we see real estate in the coming days, maybe 2 weeks, roll over inside improving and join that weekly tail back moving into lagging. If we look at materials and financials and discretionary, they're all inside lagging. Materials and discretionary at a negative heading, financials picking up slightly, but it's not the best of rotations. I hope you agree with me on that one. So that's the rotation for the cyclical, for the offensive sectors. If we take a look at the defensive rotation, and that is utilities, healthcare, and staples, then we've got the weekly rotation on the left and the daily on the right. And it's interesting because this also is not the best of rotations. If you look at staples, that's rapidly heading towards lagging. You see that healthcare used to be pretty good, but is now starting to roll over, starting to lose momentum. And you got utilities, which basically can't make up its mind, because if you look at, sorry, that's the wrong one. If you look at the rotation here over the last few weeks, it just jumps up, down again, and now up. So it's starting to rotate around that 100 level, but at a very low reading of on the RS ratio scale. So this is also a negative rotation for the defensive sectors, and that is quite confirmed when you look at the daily tail. So we've got staples moving rapidly into lagging. Utilities is picking up, but it's at a very low reading. So both daily and weekly are at a low reading, and they're sort of, hovering around that 100 level on the RS momentum scale. And then we've got healthcare, which is inside weakening and moving towards lagging. Again, for the defensive sectors, not the best of rotation. So what does that mean if both the group of offensive and defensive sectors are all so both and all these sectors are on negative rotations? Somewhere must be the outperformance. And the outperformance is in the what we call sensitive sectors. And that is quite interesting because normally you would say that you could make the argument that in a bull market, in a strong general market, you would see weak defensive and strong offensive, and vice versa. In a weaker general market, S&P moving lower, you would generally see weak offensive and strong defensive. But now we're in a situation where both offense and defense are showing weaker rotations. And it's the group of economically sensitive sectors that are actually showing the strongest rotations. On the left-hand side, we have the weekly, right, the daily. And if we go over these tails, you can see a very long tail for energy, basically underscoring the recent strength of the energy sector. And you can see over the last 2-3 weeks that it's rolling over. That is causing that long tail here on the daily, starting to pick up again. On the weekly, it's the highest reading, so I am going to assume that this is the leading part, and we will see energy picking up quite rapidly soon and start confirming the strength of the energy sector on the weekly. If you look at the industrial sector, very close to the benchmark, rolling over into weakening, and you can see the same here for the daily tail. So both the daily and the weekly are rolling over. They're very close to the benchmark, but in this constellation, in this set, I would argue that this is probably the weakest sector. Now, the two strongest sectors here are communication services and technology, and you can see why. They're inside the weakening quadrant, but they're rolling back up, they're curling back up. Communication services already almost back into the leading quadrant, and technology already at a strong heading and moving towards that leading quadrant. And that is underscored, confirmed on the daily, where you can see both technology and communication services inside the leading quadrant. A little loss of momentum over the last 2-3 days, but these are the most important tails telling you that these sectors are still outperforming and driving the market at the moment. But they're not really driving the market higher, but they're keeping the market at current levels. They're pretty much preventing the market from breaking down. And that's interesting. I could probably come up with a ton of narratives, a ton of arguments why this is dangerous, because, if it's only a few sectors that are holding up the market, that is minimal breadth, not very widely, not very broad-based. But the essence is that technology is one of the largest sector. Communication services is a pretty strong sector as well. And they are actually holding up the market right now. So let's take a look at a few of the individual charts. But to wrap it up from a 3-segment type point of view, both offense and defense not looking too good from a relative point of view. All the strength is currently in the sensitive sectors, primarily energy, communication services, and technology. So if you're looking for buying opportunities, I would say check out those individual sectors, check out the stocks that are in those sectors, because they're probably the ones that you need to look at. If we look at a few of the individual charts, then we have here materials. Well, let me bring back that cyclical sector. You can see why that is inside the improving but rolling over. You can see the weakness in relative strength here. Here is the financial sector, same story, coming out of that trend channel. You can see both RG lines rolling over. It's moving back down towards the lagging quadrant. By the way, the reason why you see differences here is because here I'm using SPY as the benchmark, and here I'm using the S&P as the benchmark. It's a subtle difference. You will see some sort of, sometimes like financials is Here inside leading, and I think that if I put SPY here, yeah, you see it's inside improving. It's a minimal difference. I personally don't make a lot of fuzz about it. For me, it's much more about the rough rotation, the direction of those movements to build the picture of what's going on in terms of sector rotation. We go to the next one here, that is real estate. I don't need to add a lot to this chart. It's holding up at support. That's the only positive thing. But if you look at the relative strength, that is clearly a downtrend, and you can see that the RS momentum line is ready to cross over and push real estate back down into the lagging quadrant. So definitely an underperforming sector. If we go to the defensive sectors, then we see, oh, sorry, this was consumer discretionary, that's right here, and you see why that is. It's just holding up above support. RRG lines are ready to move lower. Now we go to the defensive sectors, and you can see here consumer staples, not the best of charts, but look at the relative strength here. That is definitely going lower, lower highs, lower lows. RS momentum is rolling over and is pushing that staples line back down into the lagging quadrant. If you look at the utility sector, very clearly broken below support, broken below important support levels, and the relative strength here is in a clear is in a clear downtrend. So it's in a relative downtrend for the utility sector. RRG lines, RS ratio very stable at low levels, and the RS momentum line hovering around 100. That's why that tail here is, you know, shifting between lagging and improving. That's because that green line is so close to 100 and just moving, you know, around it, so to say. Nevertheless, it's a very clearly a very weak sector, and you can see that here as well on the price chart. And then we've got the healthcare sector. Out of these three, that used to be, or still is, probably the best sector, but you can see that the rally is starting to stall, is starting to falter. You know, we can't really move up much. You know, market wasn't able to push really higher, and that has its effect on the red strength line, because that is also not moving higher, and you can see that it's getting kind of tired, it's losing its stamina, it's losing its pace. And if we drop below that little dotted support line here, it'll probably start, you know, rolling that momentum line over, pushing healthcare back down towards the lagging quadrant. Basically putting all three of those defensive sectors on a negative stance, on a negative rotation. Again, just like the offensive ones, which is quite unusual, I gotta say. Usually they are in opposite directions. Makes for an interesting reading and an interesting analysis, because now we've got these sensitive sectors that are all on the right hand side, and communication services and technology are actually both showing very strong rotations. If we start with energy, then you can see that it's been pushing against the all-time high, didn't really quite manage to break it, but the relative strength is out of this little corrective mode and start to move higher. So if that continues, if we can shrug off that temporary relative weakness, then energy, especially when we can take out this high here, 92, let's say 92 or 50, 93, if we can take that out, that would certainly help the strength of the energy sector much, much more. We go to industrials, as I said, very close to the benchmark, and you can see how that is. This is, you know, moving sideways, and you can see both RRG lines. They're moving lower, so the bias would be for underperformance. So out of these economically sensitive sectors, industrials is definitely the weakest one, but it's still very close to the benchmark, and we're holding up above support here in terms of relative strength. When the ratio of industrials versus SPY drops below, where should we peg that? Let's say 0.23, 0.233. That would probably be the trigger for another move lower in terms of relative strength, and that will push that tail further down into the lagging quadrant, and very likely also be driven by more weakness in the price chart. We go to communication services. Again, since the start of the year, this has been one of the strongest sectors, probably maybe even the strongest sector, arguably. We're hovering around that rising support line. We broke it. Looks as if we're getting back to it. I think the trigger that we need to look for is a break above 69.5, 70 would be really good, because that opens up the way towards 72.5 and higher. Relative strength is actually on a good roll. It's still moving higher highs, higher lows above that support line, and you can see here that the RS ratio line has already started to sort of put in a low here, driven by that strength and momentum, of course. But when that happens, we get a new low above 100, and that will push, that's causing that tail to push back into the leading quadrant. So communication services, one of the better sectors at the moment, together with technology. And you can see why. Here also the trend channel has been broken, but we kept support around 161, which is a good thing. But the strength is in the relative terms. So we held above that previous high. We're more or less moving sideways. But you can see here that the RS ratio line is starting to put in a low just above 100, and that's causing that tail to move back up, and we're now starting to move higher on both scales, on both the RS ratio and the RS momentum line, move higher. So if we break above, and I'm going to give you the number here, that's about 394, so let's say 395.395, when XLK versus SPY takes out 0.395, that'll be a signal, at least from a relative point of view, for the sector to continue its current outperformance versus the S&P 500. All in all, not the easiest of rotational patterns, I have to say, both on the asset classes and the sectors. The good news is that technology and communication services, and to a lesser degree energy, are holding us up. But going forward, we do need to get more sectors, preferably from the offensive group, to join the outperformance, to actually give more power and more fuel for a rally in the S&P 500. As I said, for the time being, I'm still biased to a positive view for the S&P, for stocks over bonds, driven by technology, communication services, energy. But we do need to add a few more groups in the next few weeks, next few days, to actually make that a more sustainable view, and getting less risk of rolling over. I'm going to wrap up the show here. I hope you liked it and enjoyed watching it. Please leave your comments below the video as usual, and I'm looking forward to seeing you again next week at a new episode of Sector Spotlight. Same time, same place.